Okay, give it a second. All right. Looks like we are live. Give me a second here, everybody. I want to make sure that we are streaming on all the various platforms, X, YouTube, and all the other fun places where I post things which might be serious or might not be. If you're watching this live, doesn't matter what platform you're on, whether it's X, YouTube, LinkedIn, Facebook, Instagram, I can see your comments. I can see your posts. What that means is if you want to engage during this roughly 50-minute conversation and ask a question, please do so. Just put it in whatever platform you're watching. Let's make this as interactive as possible. This will be an edited podcast under Lead Lag Live on all of your favorite platforms, top 5% most downloaded podcasts out there. I'm excited for this conversation with Lobo. We did a space some time ago, and this is the first time we're doing a face-to-face from the space. Apparently now I'm doing nursery rhymes live. With all that said, my name is Michael Guyad, publisher of the Lead Lag Report. Join me for the rough 50-minute time window here is Mr. Lobo Tiggre. Lobo, introduce yourself to the audience. Who are you? What's your background? Have you done throughout your career? And where are you now?
Sure. I'm Lobo Tiggre, a.k.a. Louis James, the name I wrote under when I worked for Doug Casey, legendary investor speculator, for about 14 years. Long story short, fellow rabble-rouser, libertarian, anarchist type. And he took me under his wing. Won't say he taught me everything I know, because Rick Rule had a lot to do with that too, and some world-class geologists along the way. But basically, I was Doug's due diligence guy. He sent me to go kick rocks around the world and report back to him, try to find some good investment opportunities for our clients. And now I do that for my own clients as the independent speculator. Oh, and I'm in Puerto Rico, USA, where there are tax incentives in place that make it a supremely rational way to vote with your feet to try to starve the beast in Washington if you're so inclined.
Yes, I am a fan of fasting, but I don't think the government's ever going to fast. Let's talk about
even with Vivek and Elon heading to Washington with Milei's chainsaw.
I am skeptical that in general democracy and capitalism can coexist. That's a whole different discussion because it's not like a novel concept, but the idea that once politicians realize they can buy votes by offering more things to get voted in, there's no incentive, right?
Unless there's no return. There's a reason why Mr. Smith goes to Washington is a fantasy from Hollywood.
There you go. Let's talk about kicking rocks because it's been a nice run for a pet rock, gold, since really October of last year. I've made that argument before that if you knew in October of last year that gold would have had the run that it had, that utilities as a sector defensively would have a run like it's had, you wouldn't think the S&P would be up as much as it actually is year to date. I want to get your take on what's been driving this year-long plus momentum in gold. I get the sense that it's a signal of something probably pretty bad because I don't see any sort of other real catalysts other than momentum beginning momentum. But what's your take on things?
Well, several ways to answer that question. But actually, it's not so surprising to see gold up with the markets lately because we've been seeing that for years now. I recall that the Fed has trained with the Fed put, so-called, has trained investors to see bad news as good news. So if gold is a safe haven asset, if it's a fear barometer, as I've called it for a couple decades, then to see, it shouldn't be so, shouldn't, but to see gold up and risk assets up at the same time makes sense in a world where it's central bank policy that drives things rather than market fundamentals. Of course, that can only go on for so long. And I'm not saying the sky is falling, head for your bunker right now. But we are in interesting times. And, we kind of tore up the charts in 2008. And in response to 2020, even more, So beware of anybody who pretends to know exactly where we're going. But to get to the point of your question, we clearly have central bank gold buying, which has not gone away and has intensified. It goes up and down a bit. But the reasons for that, particularly the so-called weaponization of the dollar since Russia's second invasion of Ukraine this century, that is, I think, a one-way doorway. Nobody is going to go back to thinking that things are the way they were and that having the United States government through the Fed and the SWIFT system and the United States dollar controlling international finance. That's just not acceptable the way it once was to everybody around the world. So that's a paradigm shift that I don't think goes back. We also have two hot wars, either of which could turn into World War III. There's talk of peace now, but the wars are still there. And we have, financial disarray. We have lots of chaos around the world. So a lot of reasons for safe havens to go up. But the context is one that is very supportive for gold. And in this context, we're getting to a point right now, as you and I speak, this week, we're going to get a bunch of labor and data points where the JOLTS report should be out just as you and I started recording. And the big jobs report on Friday will be very interesting because the world is pretty clearly, if not in a measurable recession, it is greatly weakened. The trouble in Germany and in France, it's not just the pigs countries, it's the so-called core countries of Europe that are in trouble. This is a big deal. And China's struggling, stimulus package after stimulus package, and not achieving its goals. American exceptionalism has been the one thing that everybody's hung their hat on, and that's been resting on the shoulders of the worker consumer who seems to have plenty of jobs, opportunities, and keep spending. Only that has started going into reverse this year. That's the cracks in the labor market appeared last summer, more or less right on schedule. They have been widening, and as you and I speak, we are on the verge, I think, of seeing whether or not people like me in the hard landing camp, where we're chicken littles and overly worried, or whether Powell is going to pull off his soft landing. It's put up or shut up time right now as this data comes out. Oh, sorry. And, that if the hard landing types or the recession, hidden recession, rolling recessions types are correct, then that's very bullish for gold going forward into 25. And going forward into 25, it is a bullish scenario from gold from a level where we're already at nominal all-time highs or near them. Is well, I don't want to put out any numbers out there because I'll sound like a promoter or a pumper or something, but it's very encouraging.
I remember Mark Faber of the Gloom, Boom, and Doom Report, who I've contributed to for some time. I think it was in 2012 or 2013, said gold is a way to short central banks. That's sort of the expression, right? I wonder, do you think maybe gold is also a way to short American exceptionalism, to your point? Because I think this is where it gets to be interesting in terms of, this idea of exceptionalism also being a key reason for why we have a reserve currency in the dollar. What are your thoughts on that?
I think so, but we can get pretty political pretty quickly, and that's not really the point. If we go down the rabbit hole of de-dollarization and BRICS currencies and all this stuff, I mean, it may be true that they're working on a brick, or the unit, as some people call it, but the latest that we've seen from them suggests that they're perfectly happy to just trade amongst themselves with their own currencies, and then potentially we could see them going back to using gold to settle international trade imbalances, basically the way the world used to work. The BRICS currency is really hard to see. All these countries that don't trust each other, they don't speak the same language. Something that's measurable, intersubjective, to use Austrian terms, is gold. So it makes sense. But I don't want to go down the BRICS road too far. The yellow brick road, the yellow bricks road. This is a thesis that plays out over years, and Brent Johnson, my fellow Puerto Rican, the dollar milkshake guy, will point out that, we keep getting disappointed by people getting all excited about the de-dollarization and everything. And I get that. So I'm looking at what's happening now, the trends happening right now. And what's happening right now, and bearing in mind that the world is much larger than the U.S., but prices for commodities tend to be quoted in U.S. dollars. The gold-dollar exchange rate is the prime price in this marketplace. So what happens with the U.S. is very important. and we have an incoming administration that is has an inflationary agenda. And yes, if we deregulate and we slash the federal budget, we may be able to, no, not me. If that actually happened, I would anticipate an explosion of growth. And it could be that you could grow your way out of a debt dilemma. But that takes years to play out. Meanwhile, we're talking about cutting taxes left and right without touching any of the main budget line items. I mean, Elon can go in there and fire half the government. It's still not going to touch the interest payments on the debt, which are trillions of dollars. And Medicare, Medicaid, those untouchables in the budget aren't going anywhere. So the near term, what's happening now is that we have a highly inflationary scenario ahead of us. And gold historically tends to lead inflation. That's a really important point. If you correlate gold with CPI, it's terrible. And if you think about our recent experience, you can see exactly why. Gold goes up when you could see the inflation writing on the wall in 2020. And then the inflation doesn't go to 9% for another year or two. And that's classic. So in a way, I think despite the Fed cutting, the strong dollar, and other things that would normally be bearish for gold to be holding near its nominal all-time highs is telling us that a lot of people out there, a lot of players in the market are seeing the high inflation ahead, the inflation writing on the wall. Even Waller from the Fed admitted yesterday, as we're recording, that he was worried about the sticky inflation. He's worried. It's not just sticky, it went up. But yeah, so I think gold is telling us something here. And, and this is, again, not depending on de-dollarization over the next decades or something. This is what's happening right now.
Sounds like gold is sending a warning, which I've been saying repeatedly on X. Do you see the type of optimism around gold that would suggest that maybe it's now a crowded trade? I say that because, I still see a lot more excitement around Bitcoin than gold. It's not like the fervor from 2009 to 2011, whatever it was, right? Talk to me about sort of what sentiment looks like now on gold.
Well, I would separate the metal itself from the stocks. And the stocks are still in the doghouse. The stocks, if you look at average figures, they're underperforming. Why do we even bother buying these crappy choo-choo train industry, mining stocks, as Doug Casey puts it? And it's because they're supposed to offer as leverage to the underlying commodities. So if the GDX is really only up this year about as much as gold is, why did you take the risk owning those gold stocks? You could have just bought gold and done just as well. So we can go down that rabbit hole if you want, and the answer is that there should be leverage there. And the other answer to the answer is that if you look at the averages, it disguises the vast difference between the underperformers and the overperformers. So stock selection matters. If you have the better companies, you have done much better with them than just gold this year. And that hasn't percolated out to the broader market yet, which is actually very optimistic for gold stock speculators, because that realization is still ahead of us. Whereas for the metal itself, clearly the cat is out of the bag. I mean, how many months can you keep hitting new nominal all-time highs, making headlines on mainstream financial media, not just gold bug news, before people start catching on? And it's interesting, right about the point where the futures hit 2,800, you heard even mainstream types saying that the gold trade was crowded. Not the Mark Fabers or the Doug Caseys or the Rick Rules of the world, but the people that you would see on Bloomberg and Yahoo Finance and places like that. So it was interesting to see, but I don't think those people were into the gold stocks. They were looking on ways on trading gold itself, and that's interesting. And that noise, that sort of talk about, everybody's bullish gold now. I mean, even Bank of America and Citi and places like that calling for $3,000 gold. I can see where that crowded idea comes from. But that has cooled. That correction that we've seen, which is de minimis, really, for a market, volatile market like metals, gold, and silver on steroids, even more so. The correction that we've seen from 2,800 is just, the Bitcoiners wouldn't even notice such a thing, but it has definitely cooled that crowded trade noise out there. So long story short, whatever the mainstream types are doing doesn't concern me too much. Because my main speculation is not on the metal, it's on the stocks. And, I anticipate gold going up next year, but here we are, near 2,700. For it to double next year or something like that, that would be a really tall order. Whereas if we just went to 3,000, like the mainstream is expecting, that the better producers, you'd have to be a really, really incompetent producer not to gush cash at those price levels. And the better projects go forward, the better exploration companies would go forward. So I'm not expecting the metal to necessarily make me rich next year. I own the metal to prevent myself from becoming poor, as savings, as real money. But the stocks, I think, could add significantly to my net worth in the year ahead.
So why play the stocks as opposed to maybe just doing, long dated options or leaps, to the extent that they exist for some of these, gold mining companies?
Well, I'm an evil scum of the earth newsletter writer, I've been told. So most of my audience, I'm not saying they're simple, but they've got other things to do with their lives. They don't, kick rocks to think about stocks all day long the way I do. Most of them would prefer just to have a simple long strategy. Buy this, and if we're right about the underlying fundamentals, we will make money. That's just the preference from the audience. And I must say, though, that it's not just their preference. My own preference, or my own issue, is that I know that I don't have a future-seeing crystal ball. And even if I'm right about the direction of things, the timing can be off. And if you start using options, remember, options have expiry dates. So you have to not only be right about the direction or the specific asset or equity that you're betting on, you have to get the timing right. And that adds a layer of complexity and increases the chances for failure. So, it's horrible to be right about some market or some stock and still lose money on it. So maybe I'm the simple one, and I like simple longs. But, I do look at options from time to time. The one thing I don't do, and it touches on something we mentioned earlier, like if you look at averages, if you look at the GDX or something like that, and it just seems to be underperforming, that is masking the fact that you have a bunch of disappointing companies in that basket, as well as outperforming companies in that basket. So if you're a stock picker like me and you can pick more of the winners, you will beat the index, which, I have a track record you can look at. I don't want to dislocate my shoulder patting myself on the back, but I typically do beat the indices, and that's how.
Is there more opportunity in the smaller cap side of the mining space as opposed to the large caps that drive a lot of the gold mining ETFs that are out there?
Well, sure, risk and reward. It depends on what you mean by opportunity. There's more alpha, if you will, but more risk. So is that a better opportunity? Not if you're on a fixed income and can't afford to lose a dime. If you really need to protect your nest egg, you're probably better off going with the larger, more stable producers, or even betting on the metals themselves. Like personally, I don't buy the ETFs. I do think I can pick the better stocks, and I work very hard at it. But if I didn't have time, or if I really couldn't afford to lose, but I thought that gold or silver or whatever was going up, then I could just buy the ETF, and it's much more comfortable than stuffing it under my mattress. And with the right product, it's also cheaper, especially, if you're talking large amounts and you'd have to have, hire Brinks to vault it for you or something like that. Again, I'm not talking about bullion as savings. I want to have physical metal in my direct personal control in case, the unthinkable happens and things get really bad, then that is real money that I'll have, and I will be able to liquidate. And at least thousands of years of history says that that will happen. And personally, I've had experiences in my life where bullion has saved my posterior and helped me feed my family. That's a completely different thing. Whereas if I'm, a bull on something and I think it's going up, but I'm really risk averse, then, maybe an ETF on just maybe I don't care about leverage. I'd rather give up the leverage for the security. Gold can't go bankrupt, right? You can't discover an endangered mosquito on gold's property and have the mine cease, right? It's a metal. So you have much less downside as long as you're right about the commodity trend.
You mentioned silver a little bit earlier. Have the silver mining stocks performed more commensurate with the move in silver as opposed to the gold miners and gold? And, what are your thoughts on silver as the real lever play to gold?
Yeah, real is a loaded word there.
Yeah.
Silver is characteristically more volatile than gold. It has been since the gold-dollar exchange ratio was freed by Tricky Dick Nixon in 1971. Your even most ardent silver bulls will tell you that silver typically underperforms gold at first. It lags in a major market move and then more than catches up, which, why it should lag at first, it's an interesting question. That it more than catches up makes sense because it's more volatile, or simply on the price level. And if you're talking $2,000 or 2,700 versus $30, it's easier to see, a few dollars make a big difference for the cheaper item there. Where I'm at now, though, is that silver has measurably, visibly, objectively had increasing. It has moved increasingly in response to its industrial demand. The industrial drivers have become more important lately. And, some people don't like it when I say that. I get called names and so on. Yes, I understand that silver is still money, but this is not an either or thing. And it's actually not a bad thing, because when industrial demand is there as well as monetary demand, then that gives silver more upside than gold. But not to get into the whole debate again, my outlook right now is that I'm bullish on both gold and silver as monetary metals in an inflationary environment. In the near term, history tells us silver may underperform. On top of that, the industrial aspect makes me worry. If I'm right about the hard landing, and by the way, by hard landing, I don't mean we're going into years of recession or depression. I mean that the economic data shows that happening, and then I expect the money helicopters to fly again, the easy money spigots to open up, and it to become a reflationary boom. So I'm just talking about capitulation amongst the recession deniers, not an actual soup line type scenario. But if that's right, then that industrial aspect of silver would weigh on it. So whether you just want to go with silver's history of lagging or the dark silver thesis of the industrial side being a near-term potential headwind for silver, I'm more nervous about silver in the near term. I'm more confident about gold going higher, specifically in the year ahead. But when silver does go, I think it will move higher on a percentage gain basis than gold. It's just much easier for something that's $30 to go up to $60, let's say, than it is for something that's $2,700 to go to $5,400. Not only that, silver has yet to reach even a nominal all-time high. It could go up. I mean, even gold going up 50% would be a hard order without like major beep hitting the fan next year. Going up 50% would be tough for gold. Whereas for silver, that would only be 45, 46, whatever, which wouldn't even be a new nominal all-time high. So it's much easier to see bigger gains in silver when it gets going. So I'm not bearish on silver. I'm just a little more concerned about it in the near term.
Seems to me that you need to have China really be a driver on that end of things. Because a lot of the industrial commodities obviously went vertical when they initially had that excitement around stimulus and then have kind of cooled off since then. Is your view around hard landing somewhat dependent upon what happens next with China?
Well, the hard landing thesis is U.S. specific. I think the rest of the world is already visibly in a world of hurt. I have no problem calling it a global recession, whatever the powers that be want to call it. And China's part of that. And people say, but Lobo, 4 or 5% GDP growth, that's great. Most countries would be jealous if, to have that. So China's fine. Well, but it's not fine. It's not fine if they're missing their goals. It's not fine if they're used to 10%, then 8%. If 5% is the new 10%, that is a recipe for social unrest. And then if they miss the 5%, that's a problem. So it's not for nothing that Beijing keeps throwing stimulus package after stimulus package after this. And there's not a lot of 2024 left for them to hit their target. So it's interesting. But again, my hard landing thesis is US focus. I think, in the weeks ahead, we'll have the data that is a yay or a nay on that. And the difference is either like we go into the next upward cycle, which is inflationary and bullish for commodities, or there's a sharp shock or there's a buying opportunity, and then we go into a reflationary boom. So either way, it doesn't actually change my portfolio allocation much. It just changes my near-term shopping list. But on the China question, I think there's no question that if weakness persists, they'll keep throwing money at it. They'll, at some point, I have to say I'm impressed with Xi and the CCP. I'm not usually impressed by communists, but they're not really communists. They just want to stay in power. But anyway, I'm impressed by their discipline. They understand very well the property bubbles that were ignited by previous policies, and they don't want to go down that path again. So they're trying really hard to stimulate without overstimulating. And I'm impressed that they've stuck with it now for a couple years. But if push comes to shove and they're looking at, real economic malaise and social unrest, then I have no doubt that they'll do their own version of money helicopters. The difference for them is they actually have, vast stores of reserves, and they don't have to borrow the money to do it. Either way, though, I think that's bullish for commodities. China is the 800-pound gorilla consumer there, from copper to iron to, everything. I mean, gold, actually, too. They're the world's biggest gold producer, but they import the stuff. What does that tell you, right? So either they succeed, in which case the economy grows and demand for commodities improves, or they throw a lot of money at it, which is inflationary. And, whether they, it's a false life or, a fake economy, whatever you want to call it, it would still stimulate consumption and production, and it would still increase demand for commodities for as long as it lasts.
Let's talk about outside of metals, a different type of yellow commodity, which is uranium. I've been bullish on uranium in the nuclear space. I buy the argument of the very long term personally, but yeah, as you kind of alluded to, the path is what matters more than sort of the end point for a lot of traders and investors. Even though investors are supposed to invest long term, they have a funny way of not doing so. Let's talk about under a Trump administration, how you think nuclear and uranium could behave in the following 4 years.
So Trump fans hate it when I say this, but I'm just referring to facts, okay? Throw Rotten Tomatoes at me if you like. But the fact is that there was a lot of excitement about Trump supporting the U.S. uranium industry in his last presidency, and he pretty much punted. If you recall, there was this 232 petition, and everybody thought that Trump was going to support American uranium miners. Well, he didn't. He came up with the idea or a commission came up with an idea and of establishing a uranium reserve. But it was actually the Biden administration that did that and funded it, by the way. So, I know that he has recently said some more pro-nuclear things, but I'm stricken by the way on his Joe Rogan interview, when Rogan asked Trump about nuclear power, Trump sort of conflated nuclear power generation with nuclear weapons and talked about how dangerous it was. It seems like since then, Musk has gotten hold of his ear and whispered in there that nuclear is good, and Trump has said some more positive things. But this makes it a question mark. I don't know where his heart is on this, if you will. I'm not sure how much conviction he has on this. And he is, he's seen as an outsider, but he has definitely become a politician. And where is the majority of the support? How many people would be upset if he disappoints U.S. uranium versus people who would be pleased if he stays away from evil nuclear? On the other hand, there's a very large constituency now that wasn't there before, the environmental extremists. The people who think we're all going to die in 10 years or whatever the number is now on that ticking clock. They are embracing nuclear more and more now. And that is a much bigger pool of voters and supporters than uranium stock owners. So I could see a case where he comes out very strongly in favor of nuclear, especially if you need it to mine Bitcoin. And, he's made friends with the Bitcoin crowd. You're going to need it to run AI. All this. I mean, Trump aside, just how jaw-dropping is it for Microsoft to contract with the owner to buy nuclear power from 3 Mile Island and restart that reactor that was the subject of this scare, which, by the way, never hurt anybody, all those years ago? What more sign of the times changing do you need than that? I think even Germany will eventually do an about face when they have a few cold winters there. But Japan is restarting reactors left and right. And again, bringing the concept down to what's happening now. Our friend Rick Rule likes to say, don't confuse the inevitable with the imminent. And my riff on that theme is, never mind the inevitable or the imminent. I want to know what's happening now. And what's happening now is this shift, this perceptual shift, and the climate change warriors jumping on the nuclear bandwagon. That's happening now. And the about faces are happening now with Japan restarting and accelerating their restarts of reactors. And more important to the market, a restart is not like, oh, advanced nuclear, 10 years from now, we're going to have small modular reactors all over the place. That's 10 years from now. When you restart a plant, you need uranium for it now. And if you sold off your inventory because you thought you weren't going to use it, then you need to replace that inventory. So I'm very bullish. None of this, however, tells me that uranium has to do a hockey stick and go vertical again. Remember, it doubled last year. Uranium, by the way, I have to say, was my highest conviction trade for 2023, and it doubled in 23. My highest conviction trade for 24 was gold, by the way, and it's done okay. But uranium doubled in 23. It's been going sideways since it corrected, but it's still above the incentive price needed to bring new supply online, which is happening now. So it's in my view, completely understandable to have this consolidation period. But for what it's worth, we've done the math on this. We have a free download on our website, by the way, a free uranium report in the free report section of the website on this. And we think that the low-hanging fruit, this high prices cures high prices thing, that is happening, that is bringing production back online. But we don't think it'll be enough to meet the demand. And every week there's some new source of demand out there that we read about. So I'm extremely bullish. I'm not expecting a hockey stick. Like we talked about, for gold to double from where it's at now, that's a tall order. For uranium to double from where it's at now, that's a tall order too. I do think it'll go higher. I think the better companies will, they can make money in this environment and they can return gains for shareholders. But I'm not looking for a hockey stick in that space next year, absent some big game changer.
Let's say somebody is like you and bullish on those three, gold, silver, and uranium longer term. How do you even think about weighting those three? Meaning, what's the highest conviction? How do you manage risk? Because to your point, you could be right.
Let me jump in. It's not just that I'm bullish uranium long term. I'm bullish on it immediately. I mean, it corrected down until it basically hit the long-term contract price, which is on an upward trend. So I do think we're going to see spot prices dragged upward, kicking and screaming perhaps, but over the next year, I do think it's going upwards. I just think it's more likely to be a steady climb now that we're seeing new production coming online that removes a lot of the immediate hockey stick potential. But I'm bullish right away. Like right now, uranium is on my shopping list. I'm not waiting for later. But to your question, I think one of the most neatest things about this is that in some ways, the uranium as an energy or industrial mineral, it balances the monetary metals aspect of gold and silver in your portfolio. If I'm completely wrong, right, and not only do we have a soft landing, we have a no landing, And somehow, Elon and Vivek managed to cut the federal budget so we don't have this blowout deficit, and it's not inflationary for Trump to cut taxes, and immediately we're off to happy land. Everything just goes wonderfully right away. Like that ever comes out of Washington, right? But let's say that happens, and gold and silver just kind of roll over and slump next year. Well, in that environment, it's extremely bullish for nuclear power and for uranium. And so my uranium stocks should make up for the underperformance of the monetary metals in my portfolio, or the stocks based on those. Or the reverse. If I'm wrong about nuclear for some reason, or worst case scenario, there's another Chernobyl scale event, that would be very scary for the world. That would likely boost gold and silver, and that would make up for my losses on the uranium portfolio, or portion of my portfolio. I see it as an oddly enough, the two yellow metals are part of a self-balancing portfolio in terms of hedging your risks, and I rather like that. Though my outlook is actually for both to go up next year.
Anything else on the commodity side that's particularly interesting to you that you're tracking, that aside from sort of the mainstream, arguments like palladium or platinum or anything like that, that could be big winners?
Well, specifically for big winners, my highest confidence trade for 2025 is copper. And that may not seem glorious or romantic, but unlike, say, well, we just talked about how difficult it would be for gold or uranium to double next year. Copper could do that. If there's a squeeze, and there have been disappointment after disappointment in copper mines coming online. Only Friedland's operation in DRC seems to be the one that just keeps delivering in spades. But we've had nationalizations, we've had roadblocks, we've had sinkholes, we've had all kinds of things derail copper production and copper plans, and we're already in a structural supply constrained, and it just gets worse and worse going forward. It's another free report we have on our website, by the way, if you don't mind my saying so. There's one on copper. So my thesis has been that as soon as I was sure that the recession had done its worst, and that the money helicopters would fly, then I was going to buy copper and maybe oil. But now that we're at that point where I think the money helicopters fly, or fly more soon, and it's December, so I'm making my shopping list and checking it twice, and it's got a lot of copper on there. I find myself less willing to go in the oil space. Oil is also supply constrained in the sense of capital being starved in that industry, but not in the sense of raw supply. We actually have voluntary supply constraints. OPEC plus, they're meeting and postponing their meetings to decide whether to extend their cuts. Copper's not like that, right? There's no cartel trying to, reduce supply of copper to support prices. And whereas oil going from 70 to 140 would be a huge leap, for copper to go from $4 to $8, it could spike that way. But even if it only goes up 50% to $6, we've been there before. It could easily happen again. And the stocks, the companies that have some project of merit or profitable production, they should deliver, extreme leverage. So this is, for what it's worth, it was uranium in 23, it was gold in 24. I'm not just a gold forever kind of guy. For 2025, it's copper even more than oil.
Lobo, as we start to wrap up here, you mentioned that your website. Talk about other places people can find your content. Obviously, independentspeculator.com, given the background. But where else can people find your work?
Sure. Well, the main thing besides the website would be my Twitter feed. I'm the Due Diligence Guy, at Due Diligence Guy on Twitter. And I do see it as a publication. I post my thoughts on a daily basis. So if you want more Lobo that you can get from our free weekly letter, which, by the way, little self-promotion there. If you sign up for that, you may or may not like everything I say, but I can promise that we won't spam you. You get one email per week, and that's it. No flood of daily advertisements. But my Twitter feed, I actually think, is a valuable corner of the Twitterverse. We talk about current trends. I've attracted, I think, like-minded people. We tend to have less flame wars and trolls out there saying all kinds of, vulgar or just trying to disrupt the conversation. I actually find my Twitter feed to be a useful source of ideas. Or, right now, diamonds have been in the news again. De Beers just announced that they're going to cut prices by 10%. So we've talked about that. I've never really liked diamonds as a commodity, and I've been bearish on them ever since the stories about the lab-grown diamonds being cheaper and quality-wise actually better than the natural ones. And that's worked out fairly well. It's something that we've covered on my Twitter feed. But since I don't invest in diamonds, I haven't really written much about it on the newsletter. So that's another place to get all the Lobo you could want.
And I think a lot of people want more Lobo. So everybody, please make sure you check out the various ways that you can access Lobo's content. Appreciate those that watch this live stream. Again, this will be an edited podcast under Lead Lag Live, and I will see you all on the next episode. Thank you, Lobo. Appreciate it.
Sure. Thank you.
Cheers, everybody.